$4,155 per ounce. Let that sink in. While you were sleeping, gold just shattered every record in the books. This isn't a normal rally or a lucky spike. This is the most aggressive precious metals move we've seen in modern history. Wall Street won't say it out loud, but this could be the opening act, not the finale. In this breakdown, I'm going to show you why $6,000 gold is now on the table, what forces are really driving this move, and whether buying here is smart or suicidal. What you're about to hear changes how you look at money itself. Let's start with hard facts. Gold closed at $4,955.23 on January 23, 2026, up 2.5% in a single session. This isn't a one-day headline spike. This is sustained pressure against every resistance level. For months, gold has been printing near daily all-time highs. From $4,600 to nearly $5,000 in days is not healthy price action. It's panic disguised as institutional accumulation. Silver exploding past $96 confirms it. This isn't random, it's coordinated positioning. Here's what really shocked me. When Trump paused 10% tariffs on NATO nations, gold briefly dipped, exactly what textbooks would predict. But within 24 hours, gold ripped to new highs. That tells you everything. The market completely ignored the headline and doubled down on safety. This rally is no longer reacting to news. It's responding to a deeper loss of trust in the system itself. The first major force is central bank buying. Poland announcing 150 tons, China stacking gold for 18 straight months, and Russia, India, and Turkey accelerating reserves is not coincidence. These are not speculative trades. Sovereign nations don't chase momentum. They prepare for regime change. Central banks are quietly hedging against a future where the dollar no longer holds unquestioned dominance. The second force is the dollar's structural decay. The dollar index has been bleeding as erratic trade policy, tariff threats, and geopolitical pressure erode confidence. Historically, every 1% drop in the dollar adds roughly $50, $75 to gold, and we've seen sustained dollar weakness for weeks. At this point, the relationship is mechanical. Gold isn't rising because it's strong. The dollar is rising because it's weak. The third force is Federal Reserve policy expectations. Jerome Powell's term is nearing its end, and signals from Trump's camp point toward a more dovish replacement. That means rate cuts are back on the table. When rates fall, the opportunity cost of holding gold collapses. Bonds lose their appeal, cash bleeds value, and gold becomes the default hedge. This is exactly why institutions like Goldman Sachs are already pricing in $5,400, because policy is shifting before the headlines admit it. The fourth force is geopolitical instability reaching critical mass. Greenland ambitions, tariff threats, NATO fractures, Middle East tensions, Russia-Ukraine deadlock, and Taiwan risk are all active simultaneously. Gold doesn't care who's right or wrong. It only reacts to uncertainty. Every escalation, every diplomatic misstep, and every shock headline adds fuel to this rally. The world isn't calming down, it's fragmenting. The fifth force is the collapse of the digital gold narrative. Bitcoin failed its stress test. During tariffs and geopolitical spikes, crypto sold off or stagnated while gold made new highs. Institutions noticed, capital is rotating back into a store of value with no counterparty risk, no servers, no networks, and no shutdown switch. Gold doesn't require belief, it requires trust, and that trust is being rebuilt fast. Short term, the path is clear. If tariff rhetoric escalates or the Fed signals easing, gold pushes into the $5,100, $5,200 zone. A pullback to $4,750, $4,850 is possible, but any dip there will be aggressively bought. The key takeaway is simple. The floor is rising. Every correction is shallower than the last. Medium term, the targets expand. By Q1, Q2 2026, $5,400, $5,600 becomes the base case as central bank buying accelerates, the dollar weakens further, and rate cuts materialize. Long term, $6,000 is no longer fantasy. In a true currency or debt crisis, gold breaks historical behavior and reprices violently upward. The probability may not be guaranteed, but it's far higher than most are willing to admit. The confidence behind this outlook comes from the technical picture. Gold has broken out of a massive ascending triangle on the weekly chart. Momentum indicators still show room to run, and every sell-off gets absorbed within hours. This isn't retail euphoria, it's controlled accumulation. Strong hands are in charge. Macro conditions offer no relief valve. Global debt has crossed $307 trillion, no major economy is hiking rates, and there is no politically acceptable path to austerity. Inflation or default are the only exits. Gold thrives in both environments, which is why capital keeps flowing into it regardless of short-term noise. Historically, this move is not extreme. The 1970s saw gold rise 24x. The 2000s delivered a 7.6 rally. This cycle began near $1,200, and even a move to $6,000 would be a sub-5x return. below historical bull market averages. By that measure, gold is early, not late. There is also a brutal lack of alternatives. Stocks are priced for perfection, bonds lose purchasing power, real estate is illiquid, and crypto remains volatile. Gold stands alone as liquid, borderless, and independent of government promises. That's why it keeps winning the capital allocation war. The message from gold is unmistakable. Smart money is hedging against instability, currency erosion, and policy failure. Whether this becomes the trade of the decade or the ultimate insurance policy depends on what comes next. But ignoring it is no longer an option. The gold rush of 2026 is underway, and positioning early is the only real edge left.